Good morning, and great to be back in Seahawk country here. Some of you have heard me speak before, and it's great to be back here. Great to also see some very familiar faces. Tom did a really great job summarizing some of the real key components of what's driving the economy and market. I'm going to talk a little bit about how Bank of America looks at the economy and how that's translating into the market movements that we've seen year to date. Because as we all know, there's been a ton of confusion out there, a ton of uncertainty, and just a roller coaster of headlines week to week. Every Sunday night in the beginning of the year, it seemed like there was another big headline bomb that was dropped out of D.C. And just for proof of that, for those of you who have seen me before, last time I was here, my hair was jet black before the beginning of this year, and the new administration came in with all their headlines. But there's a really important lesson to learn from all of that. That when we look at investments, it's really, really important to manage client portfolios from a non-emotional stance. And what do we mean by that? We have a saying that it's really important to follow the market data trend lines and ignore the headlines. Easier said than done, as we all know, with the roulette wheel of headlines this year. If you don't trade and invest emotionally off of the headlines and look at what the data is, Tom just gave some very good data on the labor market, which has been stable and has had some movement. But sometimes you go to a family event or a party or the golf club or whatnot, and you would think that the labor market's fallen off a cliff. So that's an example where, no, the labor market's pretty stable. Is there some shifting parts to it? Yes. Is that true of the overall economy, of the consumer, of earnings growth, of corporate decision-making, corporate CapEx spending? Yes, 100%. So I'm going to go through 2 or 3 key points that I want you to take away, but I think that saying is maybe the most valuable that I can give you when you think about investing. Follow the trend lines of the data in the market and ignore the headlines. Again, easier said than done. I scared everybody here at the Swain Center at UNCW and the Business Council because I showed up with 82 slides, I think, but I'm not going to bore you to death with that. But in error, sent them like the full chart book that we have. But this is a good example here, just of a chart that how we look at it from an investment perspective, right? We have to look at it and say, what is the bull case? What is the bear case? And what is our base case, right? What's middle down the fairway? So this is a good chart, I think, that shows you in one slide how we kind of frame that out and how you look at things. It's pretty clear to us right now from our perspective with talking with companies, talking with the consumer, that the economy is on a pretty healthy platform despite all the noise. Why do we say that? Well, at Bank of America, we bank basically 1 in every 2 households. That's about 70 million households that we bank. So we have a really robust data set that we can look at and look at trends that all of us here do from our spending side. Debit cards, credit cards, loans, et cetera. And when you look at that, despite all the craziness in the headlines, the consumer is still spending low single-digit growth year over year. And we all know that the consumer is still the biggest engine of the U.S. economy, right? Roughly 65–70% of GDP is driven through some form of the U.S. consumer activity. So when we put that in as a base or a cornerstone, and then we add on the profit cycle, which I'll get to in a minute, that's how we get to our base case where we think that there's still a strong economy and a strong equity market ahead of us. Here's a chart to show you the health of the consumer. As you can see, we're well off the peak in that spike there, and we're pretty close to a longer-term average level in terms of the resilient consumer. That's a really, really key thing to look at. Again, look at the data, don't look at the headlines, right? And our credit card delinquencies, yeah, there's been a little bit of an uptick, but nothing that's really drastic, nothing that's really a problem so far. We will have to keep an eye on that. But as Tom just said, there's some shifting plates maybe in the labor market, but overall at 4%-ish unemployment rate, and with incomes, wages are still moving higher, that's a pretty healthy setup, and that's what makes sense and is logical that we're not seeing a big spike up in delinquencies, despite some of the scary headlines. Housing market's been a little bit frozen, right? Anybody who has a mortgage that they locked in 10, 15 years ago, they're not going to be quick to say, I'm going to go jump out and go get a higher mortgage rate. I'll stay where I am for now. So we think with the Fed starting to cut rates, we could see some easing on mortgage rates and get some activity there. This is a boring slide. Don't want to bore you with this. This is just Q2 performance. Maybe one thing out of this to highlight, though, is that, and let you take a quick look at, is that the overall equity market continues to surprise to the upside. We've had 28 new all-time highs this year in the S&P 500. 28. Now, most of you go home at night or you go to a party or you go to the golf course and talk to friends, and you would think, we probably don't have one new all-time high, right, given where sentiment has been. Now, back in March and April, when everyone was scared to death by tariffs that were set sky high, that makes sense. But we're not up there anymore. The tariffs have come all the way down to a level like this. So sentiment's still a little bit scared, but tariffs in reality is down here, and that's why the equity market has run up over the summer months. Q2 is a very, very strong quarter, and that's going to use that to transition to my second point, which is around earnings. Q2 earnings for the S&P 500 were expected to be 4 or 5% growth before earnings season started. Now, normally, and over the longer term stats, you go through previous cycles, if you had 4 or 5% earnings growth, you'd be pretty healthy. You'd be pretty comfortable with that. That's a good number. It's year-over-year growth. The profit cycle is accelerating. We came in at 12% earnings growth in Q2. So what happened? Why did that happen? Remember, tariffs came out all the way up here. Reality is they're down here now. So Wall Street, in all of our wisdom, the analysts all cut estimates drastically in March and April and May. They cut too much. They cut for tariffs that are up here. Earnings estimates come down, expectations come down. That sentiment I talked about was too negative. Now all of a sudden, oh wait, we're not going to pay tariffs up here. It's going to be down at this level. And oh, by the way, the US dollar continues to weaken, which helps multinational companies. We'll get to that in a second. Earnings were cut too low. We went too far. Oh, tariffs are coming down here, now earnings have to go back up. So when someone asks you at home, like, hey, the news is crazy, world's coming to an end, there's trade wars, there's tariffs, there's going to be a recession, all this stuff, why does the equity market keep going up? The simple answer is people got too bearish on their earnings expectations, and that earnings profit cycle continues. We're on to our 7th or 8th consecutive quarter of year-over-year earnings growth, and 12% is outstanding. I've been doing this a long time, and that's one of the best earnings quarters I've ever seen for the S&P 500. I can see on some of your faces, it's like shocking. It's like, what? That's one of the best earnings quarters we've had? Yes, and I'll get to a catalyst for why that is in a second. To be fair, and going back to March and April, there was no shortage of downside risk factors. Geopolitical issues, tariffs were way up sky high. There was concern about trade wars. There was concern about potential recession, but that quickly unwound and did not happen. When did the equity market start to rally? In May. So if you go home and on Yahoo Finance, Bloomberg, FactSet, whatever you use, and look at even just a 6-month chart in the S&P, they call that a V-bounce. That V-bounce was because we came off the crazy, insane tariffs that were initially thrown out there and came back down to something that's more reasonable. Right now, and this is a moving needle because, as we all know, the headlines still keep rolling through out of D.C., but the actual aggregate or average tariffs that are impacted for Q2 settled out around 13-14% for the S&P 500. Not 70%, not 100%, not 50%, 13-14%. So you can see that's a long way from the 100 or 100 plus that we were throwing at China, back and forth each headline every Sunday evening, and a key reason why their earnings expectations got too negative. So this is a good chart that kind of just shows you how the cycles really work. And I think it's important to see that these bull markets tend to be a lot longer than the bear markets. The bear markets are usually very short relative to the length of bull markets. Why is that? Well, number one, when you get into a profit cycle, it usually rolls through for a couple of years. Like I said, we're on to our second year of this profit cycle growing for S&P 500. It wasn't that long ago, we were in 2022. S&P had a really down year. You guys looked at your accounts in 2022, you were probably not too happy on your equity portfolio. Well, that bounced back right away in 23 and 24, led by the Mag 7, the mega cap technology stocks, the Amazons, Googles, Apples, Microsofts, Nvidias of the world, because then they quickly bounced back to double-digit top-line growth and earnings growth. So that's super important. Time in the market matters. This is really, really important. So I gave you the little catchphrase on watch the market trend lines and the data trend lines, not the headlines. This is also maybe just as equally important in terms of your investments. If you try to time getting in and out of the bull bear market cycles that we just showed there, I can guarantee you the majority in this room will get it wrong, myself included. Myself included. It is a very low batting average exercise to try to time the market. Why? Goes back to one of my first things I mentioned. You get emotional, things come into play. You're trading or making moves based on emotional short-term decisions, not on what your long-term plan or goal is. And that's why it's super important to have financial advisors and wealth managers that set up a long-term plan with you so you don't fall for the pitfall of short-term trading and trying to time the market. If you look at some of the stats on this, you miss those 10 best days, your returns are extremely, extremely negative compared to just staying the course and staying invested. You lose a lot on your returns. So important lesson there. I'm going to pause on this for a second and just talk a little bit about earnings before I wrap up with themes. That earnings growth I talked about, 12%, was way higher than anybody's expectations, right? 4 or 5% was Wall Street consensus. The full year, we're probably looking at high single digits, maybe low double digits earnings for the S&P 500. We have inflation that the Fed did a great job capping and coming off the COVID spike, bringing it back down to around a 3% level. From our personal view at B of A, we're okay with a 3% inflation world, right? That's not a terrible world. Think about what it was back in COVID, 7, 8, 9%. That's a tough world to work in. 2, 3%, that's more normal. That's like a normal economy, normal business cycle. So we don't think that the inflation side is a huge risk at this point. As a matter of fact, when you look at what nominal growth will be, that inflation helps the overall GDP. If we have real growth of 2 to 3% in GDP, and we have 3% inflation, your nominal growth is 5 or 6%. Going back through history, looking through the long-term cycles, that's a pretty healthy economy to be in. What does that also help besides companies who are growing? Helps the government, right? We have big budget deficits. Having a little bit of inflation in there isn't a bad thing as well. So inflation was scary coming out of COVID, but it's not always the worst thing in the world. And the earnings growth that we're seeing, whether it's a high single-digit number for 25 or low double-digit, like 11 or 12%, we think we could see 8 or 9% next year in 2026. That is a really good setup for the equity market. We have interest rates coming down, we have inflation off the scary peaks, and we have earnings growth accelerating. Earnings growth is the fuel for equity market, really is. It's just pure fuel for the equity market. And stocks in the equity market discount and move ahead of some of that data you will see. So that's why when you say like, oh my gosh, the news headlines have been insane all year, constantly, consistently, some news always coming out and changing, that's fine. That's the headlines. Earnings continue to grow. The stocks lead that and move forward with that. So last thing I want to talk about, or actually, real quick, I'll talk about valuation because that's an important topic and you guys can ask some questions on that. But valuations are definitely extended within the equity market. The reason why it's not a huge concern for us right now is that you have that earnings growth behind it, right? Earnings is the fuel for the equity market. If we were at 2, 3, 4% earnings growth, then maybe that 22 times PE multiple, price to earnings multiple on the S&P 500 would be scarier and be more of a problem. But we're not hitting the panic button on that because the earnings growth is there. We continue to remain overweight U.S. equities and we want you to continue to own them and put money to work on pullbacks in equities with that earnings growth behind it. So last point on thematics, that time in market chart, you can see if you miss a couple of the best days and you try to time it and you get it wrong, and you will, trust me on it, you will. If you stay in the market and stay invested and position your portfolio to have investments to the leading themes, it's not by accident that those are some of the higher growth areas in terms of earnings, right? Think of the tech sector. Now it's more than the tech sector. AI is going to give us an innovation boom and a whole regime change where companies are going to be more efficient. Productivity numbers are already starting to move higher, and I'd argue we barely have used AI in the real world so far. You know, every boardroom of every public company around this country is sitting there and has at the top of their agenda at that board meeting, how do we work AI into our business? Why? Because they know their competitors are going to do it. They know the rest of their industry is going to do it. And it increases their profitability and therefore their earnings. So it doesn't matter if you're in healthcare, if you run a power plant, you're a utility, you're an oil driller in Texas, you're Costco or Walmart with their monstrous inventories and their huge supply chains, on and on and on. I can give you an example across every sector, every industry that is going to use AI in some way, shape, or form. And what does it do? It improves their business. Small and mid-sized companies are going to do this too. Right? It's not just the large ones. The large ones have the advantage. They have the size, the scale, multiple supply chains, so it's much harder for a small business to do this. But they too will come around to finding ways to use AI to make their business more profitable. So that is a huge theme. It's a huge game changer. You probably have heard the stats, but we have hundreds of billions, with a B, being invested this year in 2025 and next year in 2026 by the Mag 7, by the big hyperscalers. Hundreds of billions per year, not over 10 years, per year. Now, at some point, it'll be overinvested, sure, but our view is we're in the early innings of this because we haven't even powered up one of these new AI data centers. Not one's been plugged in or powered up. So I don't know how we have a bubble and we're at a top and we're going to have a blow off on that when you haven't even turned one of these new AI data centers on. And I would argue also anybody who's in construction knows that these type of projects that are long cycle projects take a very, very long time. They are not overnight projects. They are not done in a week, a month, or even a quarter. They'll probably take 6 to 12 months on a fast timeline with everything lined up and everything going. So this is going to be with us for a while. You're going to hear about this over the next couple of years. And the main takeaway is that it is a huge boost to CapEx spending, which we haven't seen in a long time, and to profit growth and profit margins. Yes, we're going to have some tariff costs that are coming in. Yes, they're not where they were, but they're still there. So there are going to be higher tariff impacts, but we think the productivity is also going to go up. And as AI gets implemented more and more across more and more sectors and industries, that's going to help support earnings. So I'm going to leave it there. We'll be around for questions after, and thanks for your time, everyone.